Hello everyone, welcome to today's video. In financial markets, CFDs and futures are two of the most widely used instruments. But very few people truly understand their structure, behavior, and how they react to market conditions. And here's the interesting part. By using real market data from futures, you can increase your CFD trading accuracy by up to 50%. Let's start with the basics. What is a CFD? A CFD, or contract for difference, is a type of trading instrument where you don't actually own the underlying asset. You're simply trading the price movement, whether it goes up or whether it goes down. CFDs are flexible. You can easily buy long or sell short, and there's no expiration date. They're accessible for beginners because you can trade with small position sizes, although the spreads are usually wider than futures and the leverage can be very high. Because CFD prices come from brokers rather than an exchange, they don't always reflect the real market perfectly. In short, CFD is a speculative instrument, not part of the real underlying market. What are futures? Futures are standardized contracts traded on major exchanges like CME, Binance Futures, or OKX Futures. Unlike CFDs, futures have expiration dates, unless you use perpetual contracts. Futures offer transparent pricing, extremely high liquidity, and very reliable charts thanks to massive trading volume. Fees are lower, spreads are tighter, and everything is regulated according to market rules. In simple terms, futures represent the real, official, and highly structured market. How are CFD and futures similar? Even though their structures are different, they share some core similarities. Both allow you to trade based on price movements without owning the asset. Both support long and short positions. Both use leverage. And both work perfectly with technical analysis, price action, trends, and even volume-based strategies. Their charts often look similar, because CFD pricing generally follows spot or futures prices. How are they different? Their differences lie mainly in structure and market behavior. CFDs don't have expiration dates, their prices come from brokers, and they usually have wider spreads. They're less transparent and sometimes experience artificial spread widening, especially during volatile moments. CFDs also offer significantly higher leverage, sometimes up to 1:500. Futures, on the other hand, are traded directly on exchanges. They are transparent, liquid, consistent, and rarely suffer from unexpected price distortions. Leverage is lower and depends on the exchange, often between 120 and 1:125. In terms of risk, CFDs can expose traders to broker manipulation, such as stop hunts or price discrepancies across different brokers. Futures prices are unified across the market and reflect real buying and selling pressure. So the bottom line is, CFDs are more flexible but futures are more accurate and reliable. Can we use futures analysis to trade CFDs? The answer is yes, absolutely, and you should. Most professional CFD traders rely heavily on futures charts. Why? Because futures prices are transparent and far less noisy. CFDs may suffer from spread widening, broker adjustments. Futures also provide real, meaningful market data, actual trading volume, open interest, institutional liquidity zones, real support and resistance levels, and genuine market behavior patterns. Important structures such as breakouts, false breaks, liquidity grabs, order blocks, or supply and demand zones are all much clearer on the futures chart. When you analyze futures but execute trades on a CFD platform, you get the accuracy of real market data while keeping the flexibility of CFD trading. This combination can improve your trading accuracy by 30 to 50%. Final conclusion. CFDs are great for beginners, small capital, simple trading, and flexible execution. Futures are ideal for serious traders who need accurate data, volume information, and a professional market structure. But the most powerful approach is this. Trade CFDs. But analyze using futures. It's the most effective and reliable method, and it's what professional traders around the world use.